Okay, sorry, I got a little, daydreaming a little. Okay, page 7. We just finished calculating on page 6 the consolidated net income. Now we're going to calculate ending consolidated retained earnings. And this is going to be cumulative, not for the year. And again, it has to be after tax, because remember that net income is closed into retained earnings, and net income's after tax, so it also has to be. Okay, again, you know this. We're just going to add on those two little pieces. So, parents' retained earnings, end of year 4, which is on page 5, is $16,400. So take a sec, go find it. Now, normally, but now that we have a new schedule, which one of these do you think we have to put on here? On your unrealized realized schedule? The downstream, because that's the parent. Okay, downstream is always parent. Parent's driving that. So we're going to plus or minus. This is new. Plus or minus cumulative downstream transactions. So we look at our little chart. Downstream unrealized. So which number of these three should I use? The 105. And we're making net income go down, so it's going to be negative. So 105, it's after tax, and net income is going down. So that works off to 16,295, and that's adjusted P's retained earnings. Good with that? Okay, so now we add. Now this was a little trickier because we had to take the subs retained earnings, end of year 4, which is on page 5. But then we had to subtract the subs retained earnings at when? Acquisition. And that's on page 4. So, go find those two numbers. Okay. So they should be 6090 and 4500. 6090 and 4500. So we do that, and that's increase in subs retained earnings since acquisition. And that should be 1590. And it's okay if it went negative. So don't panic just because things go negative. And any of these. Okay, except your goodwill calculation. If your goodwill calculation is negative, unless I said it's a negative goodwill, you've done something wrong. Okay? Okay. Now, in the earlier chapter, in chapter 5, we plus or minus cumulative changes in acquisition differential, which is on page 5. Just have to find page 5, and then I'll put it up for you. Okay, so here's our acquisition differential changes. Now, where are we standing? We're standing at the end of year 4. So any changes, if there were 4 or 5 columns, like year 4, 5, 6, whatever, we'd add them all up. Remember? And this one, only 1 year's happened. So it's just the 650. Okay, we're standing here How many changes have happened? Just 1 year's worth, 650. That'll be cumulative. So it's 650. And was net income going up or down? Down. So it's negative. And remember, with AD, we're assuming there's no tax, just to keep it simple for you. Okay, now our new stuff. What do you think? Plus or minus what? Cumulative, upstream, transactions, and that's from your realized, unrealized gain. Which is over on page 6. So remember, we're splitting downstream and upstream. So this time we want upstream. And which number do we use? 80. And remember, it's after tax. And which way is net income going? Down. So, then we get 760. Then we have to take controlling interest of 0.90 to get 684. And that gives 16,979. And that's consolidated retained earnings end year 4. And this is going to go on the balance sheet. Oh, sorry, it was so crooked. Okay, now before the statements, we have to calculate ending NCI on the balance sheet. So this goes on balance sheet. So cumulative and after tax. So we're going to add to our little formula that we had in chapter 5. NCI on the balance sheet is the NCI percentage times the subs, common shares, plus sub, retained earnings, plus the balance in changes in AD, plus or minus cumulative upstream unrealized. Okay, so let's put this together. And remember, this is at the end of year 4, not at acquisition. Okay, so we know it's 10%. That's always good. At the end of year 4, how much are the subs common shares? So that's on page 5. 8,000. And you could also get it from acquisition. Because they will never change, because we're not doing that part of consolidations. Okay, and the retained earnings at the end of year 4 is 6090. And that's just from the statements on page 5. Now, we need the balance in the changes in AD. So notice it's about the balance sheet, so we take the 4850. And finally, we're just going to do upstream because NC is all about upstream. And we want Q changes. So there's only been one change, that's upstream. So it's the 180. And we're going to subtract it because netting coming down. And that should work out to 1876. And it goes on the balance sheet. Okay, now we can do the consolidated statements. On page 5. So we did all this work so we can do the consolidated statements. Okay? So, going to page 5. And keep these handy because we're going to have to pull numbers off them. So, what we have to look at, I'm going to do basic transactions in orange. Basic transactions, changes in AD, realized, unrealized, and then our calcs. Net income, retained earnings, NCI on the balance sheet. Let's start with the basic transactions. Okay, the basic transactions are on some page that I can't find. Page 5. Oh, right here at the bottom. Okay, so upstream sale of 5,000, downstream sale of 4,000. It doesn't matter. You can add these together, so combine them if you want, but you don't have. I'll put them separately so you can easily find them, but then if you take some shortcuts. So let's start with the 5 and the 4,000. We need sales and cost of goods sold to both go down by 5,000. So sales, and I'm using the direct method, minus 5,000. Cost of sales goes down 5,000. Then we do the downstream sale of 4,000. Same thing. Sales and cost of goods sold, or cost of sales. And notice I left a little space here. Cost of sales often has a lot. So does income tax expense. Okay, so we've done 2 of them. We've done upstream sale, downstream sale. Now we need to do the subs loan to the parent. So notes payable and notes receivable have to go down. So, notes payable must be in the current liabilities. So we take off, well, how much was it? Going back to page 4. Page 4, the notes receivable was 100. So that's 100, and the interest was 10. So we have to take off 100 and miscellaneous assets. You'll have to pick where it is if it doesn't have its own category. And now interest, revenue, and interest expense we have to take off for 10. Expenses, miscellaneous, and other revenues. So we can check those two off. So this is how it's looking right now. Okay, last one under basic is subs dividend. We need to eliminate a dividend of 81. So this one is the weird one because we fix it in the calculation for retained earnings, so you only take one off. So minus B1. Maybe make a note under that, only off dividends income. Okay, everybody good with that one? Okay, I'm going to start a new video and then we'll finish this off.